There are many real estate funds that invest in various properties and other real estate related investments. Today I'm going to share some of my favorite strategies for a new real estate fund. Hey, it's Frank Nagy and welcome to my channel where we help financial entrepreneurs grow their business in the financial markets. If you're new here, subscribe to my channel and hit that like button. Triple net lease properties. Leasing out a piece of real estate is how real estate investors often make money, even though there are many different types of leases. The triple net, or NNN, lease has gained popularity due to its ease of use. You'll see them all over the place, and among the notable tenants with triple net leases are Burger King, Walmart, CVS Pharmacy, and others. Taxes and insurance and upkeep are all the tenant's responsibilities in a triple net lease arrangement. This shifts all the responsibility and unpredictable nature of these costs over to the tenant and not the owner. The largest risk with the net lease is that if the main tenant defaults or declares bankruptcy, finding a new renter to replace the original tenant can be extremely difficult. Stick with an investment-grade tenant who has a credit rating of at least BBB or better from Standard & Poor's. This minimizes the tenant's default. And it also shows the company ability to repay its outstanding debt obligations. Apartment buildings. Investment funds may discover that investing and managing apartment complexes offers a greater level of physical and financial effort than managing single-family units, including smaller apartment buildings, in your real estate portfolio, which can also benefit not found in other markets. And when purchasing an apartment building, consider the location and the number of apartments in the building and available amenities and the building's condition. These factors will assist you in determining how much rent you may be able to charge, as well as how much money you'll be able to need to spend on necessary repairs and improvements. The overall condition of the building can also indicate how frequently repairs will affect your monthly cash flow. Small apartment complexes will be less expensive to invest in than larger properties, with more units if your real estate fund has limited starting capital. However, because of their size, they can bring in less money from renters. If you're considering starting a real estate fund or any type of hedge fund, hiring an experienced hedge fund consultant like Frank Nagy Financial Services will help reduce the burden of setting up your fund. Real estate investment trusts. The simplest way for your real estate fund to begin investing in commercial real estate is through a real estate investment trust, or REIT for short. Instead of putting all your eggs in one basket by purchasing a building outright, your fund can invest in a trust, which then invests its cash along with other investors and then moves those cash into other properties that produces passive income. Publicly traded REITs do not pay corporate tax on their profits as long as they receive at least 75% of their income from real estate and distribute at least 90% of their taxable income to its shareholders, like your fund. REITs can invest in a variety of properties such as apartment complexes, offices, hotels, self-storage, and healthcare facilities. REITs are also extremely liquid. You can sell them quickly in the open market at any time. Mortgage-backed securities. A mortgage-backed security, or MBS, pays investors a monthly prorated share of homeowners' principal and interest payments on their mortgages. The issuer collects monthly payments from a pool of mortgages and then distributes a proportionate amount of the collected principal and interest to the bondholders, like the fund, in a pass-through environment. Currently, there are three types of issuers: Ginnie Mae, Fannie Mae, and Freddie Mac. Ginnie Mae is the only completely owned government corporation backed by the full faith and credit of the U.S. government. The goal for Fannie Mae is to ensure that mortgage funds are available across the United States. And a real estate fund can purchase these type of securities with a minimum investment of $25,000 with $1,000 increments afterwards. Fannie Mae is a publicly owned government-sponsored corporation that is not officially insured by the U.S. government, and its mission is to keep the secondary market for mortgages. The last one is Freddie Mac. Freddie Mac is the most common pass-through MBS. Freddie Mac is a publicly traded, federally supported corporation that is not directly backed by the U.S. government, but the availability of the mortgage, credit, and residential financing is its primary goal. The majority of Freddie Mac's funding comes from creating and maintaining a vibrant secondary market for residential mortgages and its originators, which include neighborhood banks and mortgage companies. If you have a mortgage, it is more likely it's being held by Freddie Mac, but it is serviced by your neighborhood bank. Depending on the type of MBS issue, the secondary market for these securities are generally liquid with an active trading by dealers and investors. Hey, if you're thinking about starting a hedge fund, I recommend my book, The Ultimate Hedge Fund Guide. Click on the link below in the description box to find out more.